All right, we're getting close here. I'm not 100% sure you can hear me, but let's check the deal. People still working their way in, so that's good. Jessica, you know if you can hear me on this? You might confirm. Okay, I'm good to go. So it sounds like you guys can hear me. All right, I am going to get this started, get this thing cooking and go. All right, well, welcome. I am Dan Romero, and thank you all for joining us today. I'm going to be going over Q1 economic review, things that are going on out there with the markets, how we're approaching the first part of the year here, and what's coming up next. So with no further ado, we'll jump on into this thing. So we do these, and I bring it up each time. An educated client is really our best client. So it's not one of those things where we just kind of want to do our thing behind the scenes. For folks that get involved and can learn about what we're doing here, it's fantastic. So we want to give you that information so you have a good idea what's going on with the portfolios. It helps you navigate a little bit better. So let's look at the first quarter. The first quarter was certainly a rebound from last year. Last year was pretty rough with a tremendous decline in the stock market, but we saw a bit of a not a pullback, but an increase back with the market again. So the S&P was up about 7%. The Dow Jones was about flat, up about 0.4%. So it's good to get that rebound cooking again. And so we're happy about that, and we'll see how things progress on a going forward basis. Now, what particularly made last year interesting was the amount of volatility that we had. You can see in this chart here, it shows the number of days that the market either goes up 1% or down 1% within a year. And you can see that last year there were 75 days. Strangely, it seems odd, but there were 75 days where the market was up at least 1%. But there were 76 days where the market was down at least 1%, and then everything in between. So all of that led to not only just a traditional decline where the market was down just about 20% for the year, but also creates a lot of volatility mid-year. So it brings more stress to the portfolio, to everything along those lines. Because even when things go up, it may urge people to go back in and make decisions that aren't totally sound. So a lot of different things that can happen in that front. So, and this year already, you can see there's been a handful of days that we've seen that, but it doesn't even compare to last year. So volatility has definitely been top of mind. Inflation has continued to risen, although we're starting to see it pull back now. So January, we saw a 6.4% increase, which was a decline of just over 7 from December. February fell to 6, and the most recent numbers in May here were showing at 4.9%. The primary driver is coming from the energy sector. Oil prices have been going down in a pretty significant way, so we're seeing it slightly at the gas tank. Food prices and things like that are still remaining pretty high, but energy and housing have been the two areas that are leading this decline right now, which is potentially good when it comes to what the Fed has been doing, and we'll jump into that. And of course, what the Fed has been doing is they've been raising rates in a pretty aggressive manner. So they started basically in March of last year. They raised the rates 25 basis points and have been on a firestorm ever since. Probably the fastest interest rate hikes that we've seen. We've gone from 0 to 5% in a matter of 9 months. We've slowed down a smidge this year with a couple of 25 basis point increases. So I think what we experienced last year is going to be unique to last year. I don't foresee that in 2023 we're going to see the same type of interest rate hikes that we did see last year. Maybe one more will occur in June, but we'll see. Even that one I think is maybe tabled for now. We'll see, but a lot can happen. Now let's look at Treasury yields. If we looked at this in 2022, you were basically getting nothing. But we can see that the Treasury yields have pulled back a smidge. The 5-year, 10-year, 20-year, and 30-year, they were as high, a little bit higher in January and pulled back a little bit when you look at them in March, and they've kind of stabilized at that point here. But we're seeing really good interest rates that we hadn't seen in a couple of decades, really. It's been a long time, maybe going back to 2007, since we've seen interest rates like this on long-term sort of safe assets. So that is encouraging for folks that are retirees. We can generate more income from bonds in that portfolio. But even for folks that have a degree of safety in their portfolio, we can now generate a little bit of a yield, which has really been helpful as we manage money here. Now, when we look at Treasury yields, you can see here that the target Fed fund rate really fell off a cliff in 2008. So this was coming out of that financial crash. They lowered rates to virtually zero. And then in 2016, they slowly started raising rates again, and then had to take them back to basically zero when COVID hit. And then, of course, you can see there in 2022, almost a straight line up with rates going up. So the 3-month Treasury bill certainly follows that very closely, and you can see that you're getting very good interest rate returns on on these types of short-term debt vehicles, which we've been using pretty aggressively in our portfolios. So it's great. Now, what you need to understand, and this is what happened to a lot of folks last year, this year we have probably gotten about 25 referrals. There's a lot of business coming in, so we're able to see what some of these other advisors are doing out there. And it's very interesting. This is a very simple concept for folks in the industry, but when interest rates go up, the value of your bonds go down. So think about it. If you bought a $10,000 bond in 2022, paying 1%, and then rates go up, and now that same bond is not the same bond, but a new bond, let's say it was a 10-year Treasury bond, is now paying 4%. If you're sitting on that $10,000 bond that's paying 1%, no one's going to want to buy it if I can turn around and buy another bond that's paying 4% because rates have gone up. So what that means is the value of your bond that you bought that's paying 1% would be worth less, and you might have to discount it 15, 20, or 25% to make it worthwhile for someone to buy it. Now, remember, with a bond, if you hold it to its maturity, you're going to get your money back. But when it comes to investments with your statements and things like that, we have to value things real time. And so the real time value of these bonds went down drastically. So rates went up last year, the value of bonds went down. Now, inverse to that, if interest rates start going down, expect the value of your bonds to go up. So that's kind of led us into what the portfolio moves that we've been making this year is we're leaning into longer duration bonds now because we feel that the Fed may be towards the finish line of raising rates and potentially even lowering rates at the end of this year or next year. Now, the Fed has been pretty clear that they're not going to be lowering rates this year, but the bond market is pricing in bonds in that the Fed will be lowering rates in consideration of a potential recession. So again, you can really get rewarded handsomely right now with safe money. But if you don't do anything, you're still getting slapped. You know, banks are not in a hurry to pay. So your checking account and traditional savings still are not paying that much. The bank money market rate is still at 32 bips, which is very, very low. And you can see the Fed fund rate is at 4.85% there. So you can find much, much, much better savings than what you are doing at the bank if you just leave it there, which is actually helping to cause some of the stress on the bank because people are pulling their money and putting it in other things. So we have money markets here. We've got Treasury bills, T-bills, CDs, all kinds of stuff that we've been able to help people with. So if you've got a lot of money sitting in cash, we can really get you some nice returns on that front. So give us a call. Now, we talked about what was going on with the economy. Inflation has been curbing, but in certain sectors, the grocery store, things like that still seem pretty expensive, for at least when I go. The geopolitical uncertainty remains. We still have everything that's going on in Ukraine and China and around the world right now. A lot of it also has to do with the fact that there are countries that are demarking the dollar from energy trades. So we're having to deal with that headache as well. That creates opportunity internationally and perhaps in precious metals to look at. But still, there's still some positive news. So the news is mixed. So when we look at it, the job numbers still look pretty good. 236,000 jobs were added in March. The unemployment rate 3.5%. So it is a degree of a mixed bag. I just got off a review with a client. They said the industry he's in is booming, never been busier. So there are some things going on there that are pretty good, but there are other areas that are just getting decimated. So because of all this, we're continuing to advise our clients to proceed with caution. You know, if you're 25 years old and you've got your whole life ahead of you, go ahead, push all into the market and don't even sweat it. But if you've built up a nice portfolio and you're getting closer to the finish line or perhaps already in the finish line, we think it's prudent to proceed with caution right now because a lot of things could happen. When it does come to your stock market investments, we cannot reiterate this enough. The portion that you have in the market, you want to consider that as a long-term investment. If you're planning on buying a house next year, you don't want to have that money in the market because that's too short-term of a horizon. And anything could happen. Certainly the market could rebound. You can get some nice returns that would help you with your purchase. But inversely, if the market does not do well, that's really going to put you behind the 8 ball. So think of anything in the stock market as a long-term investment. We're looking 5 years out. Now, some takeaways from the presentation here. Potentially, we might have more interest rate hikes, maybe one more in June, but even that, like I said, seems weird. Borrowing costs have become more costly. So if you have not, if you weren't in a great loan last year and the years prior, then you're kind of stuck right now. You're going to have what you have, but rates are very high. You're looking at 30-year loans in the 6% to 7% range. Take a look at your income producing investments. So if you're not getting good dividends right now, there's a lot more opportunity than there would have been. Be careful about what the media talks about. They're really focused on things that create headlines and get ratings, but it's not necessarily always the truth. And again, practice patience and focus on the long term. And get this to work here. So we're still in this bear market. We'll see how things go. Continue to revisit your budget. We're finding that discretionary purchases are waning right now, although, you know, a lot of people are still putting money on their credit cards. So, but just kind of rein in on what you're doing and ride through this thing here. Obviously, there's some things maybe you don't need as much. And as we head into this recessionary environment, never hurts to just kind of be careful what your budget is and make sure you're living within your means. Obviously, we help people to devise a nice, well-tailored plan. We're going to continue to proceed with caution, and we are always here for you. So even after this presentation, you're welcome to give me a call and email. I will give you an opportunity to ask some questions at the end. So feel free to start typing those up if you got them in there, and I'll tackle them. So Warren Buffett just had his shareholder meeting, and he sends a newsletter out to everybody, and some good comments that kind of came out of it that we were able to dissect. But first one, the weeds wither away in significance as the flowers bloom. So when things do get better, then the bad news you hear about goes away. And we are on an uptick right now. So that's always important to consider. And the world is full of foolish gamblers, and they will not do as the patient and not do as well as the patient investor. So that's Charlie Munger, his partner in crime up there. Again, a lot of people are chasing the quick dollar. You know, where can I try to make as much as I can quickly, but when that stuff blows up, it blows up pretty healthy. And that's one of the things that happened last year. While the market was down 20%, there are plenty of investments that were down 70, 80, 90%. There was a bloodbath last year, depending on how you were allocated. And so but we were really, it was really necessary for us to continue to be cautious and work our way through these rough times, come out on the other end here. And then again, when we talk about what's going on with the dollar across the world, Warren Buffett puts it really well. I've yet to see a time when it made sense to make a long-term bet against America. And I doubt very much any reader of this letter will have a different experience in the future. So right now, that's all you're hearing is potentially that the dollar may be demarked from energy. We'll see about that. You know, it would be a very difficult item for the world to handle. And at the end of the day, America is still, even though there's a lot going on right now, there's a lot of headaches and problems, still the best of the best. So, you know, we're still pretty strong when it comes to our confidence in the United States and our economic system. So when it comes to investing, discipline in place and patience can be very rewarding. So Again, we appreciate you sitting in on this seminar. We appreciate you individually. I mean, you guys are fantastic. And the best compliment you can ever give us is an introduction. So keep in mind, maybe some people aren't ready to work with us yet, but if you'd like to add someone to our mailing list, we could do that, or maybe potentially invite them to attend one of these presentations. We've also been doing a market minute on YouTube, and what we do is our investment committee meets every Thursday to go over all our portfolios. And then on Friday, we have to get it through compliance is when it usually gets issued out. We'll do about a 1-minute weekly update of what we're doing right now in the models and what we think of things. So it's been pretty popular. So take a look at that. You can subscribe to that on YouTube. If you like, we have a text system where we could even text it out to you. So if you'd like that, just contact us. And most importantly, we have to give you all the compliance information that is crucial to a fruitful relationship. And it's very important that you read all this as much as you can. It looks like we do have a couple questions, so I will jump into this thing here. Okay. You mentioned you have access to good liquid savings. Currently, I have 4.85 with no penalties for withdrawals, cost only $5 a month. Can you refer me something better? 4.85 is pretty good, especially if you have liquid assets. We can get over that with treasury bonds if we're buying 3-month treasury bills. So, but then we have to keep relooping them every 3 months. And they can go up and down in value slightly, but it's such a short period of time that it handles in 3 months. But that's a pretty good rate for someone that's getting that right now. If you're not getting anywhere above 4%, you definitely, someone else, give us a call. And I guess the other one's just a nice comment. So thank you for that. If anybody else has any other questions, then please do give us a call or drop me an email. We can talk about your situation personally. But that's all I got for today. Thank you for attending.